Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and how all of this impacts our decisions on the best courses of action for your portfolios. So thanks for taking the time out of your busy schedules to join us. We are recording this live so that those who can't join us for the live event can tune in when it's more convenient. I'm joined by my partner and colleague, Paul Tepsich, the founder of Highrock, and also on the call is our financial planner, Bianca Tomlinson. And we'll have a Q&A period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to jump in and ask questions. Highrock was founded by Paul in 2010, it was initially started to manage a series of mutual funds for Bank of Nova Scotia, for Scotiabank. We are registered with the Ontario Securities Commission, which is an agency of the province of Ontario. Now, I've said this before, but I'll continue to repeat myself. For us, this is a very important difference from a regular financial advisor who is only licensed by the Self-Regulating Investment Industry Regulatory Organization of Canada, and that's a mouthful, so we normally call it IIROC. In essence, and more importantly for our clients, this holds us to a higher level of fiduciary responsibility, and we think it's actually a very important difference. So basically, we are not financial advisors, and that is, as I said, an important difference. We are a portfolio management company who has a clear understanding of wealth management. And for our clients, this means that we build your portfolio strategy based on your personal and family goals. Most financial advisors do not even have direct contact with the third-party portfolio managers that they use for their clients. Well, our clients have direct contact with the portfolio management team that is looking after you. We develop a plan with you and for you and develop a portfolio strategy that best suits your plan. The synergies and scale that we have with the fund management side of our business allows us to pass on cost savings to you, our clients. In a low return world, this can add significant value to portfolio growth over longer periods of time. We think that's important. We not only have to report to the OSC, the Ontario Securities Commission, on a regular basis, but we have something that no one else offers. We have an independent review committee that reports directly back to our clients to ensure them that we are doing everything that we say we are doing, putting our clients' interests ahead of our own. My reason for joining Paul at Highrock was to be able to offer something different and better, not just to talk about it, but do it. And we have that formula in place. We look forward to being able to put it to work. Okay, so let's move on to our broader view of economic developments, and let's check in on our themes for 2015. So at the beginning of this year, I suggested that in my daily blog that this would be a year to expect the unexpected, and this theme definitely continues. Falling oil prices at the beginning of at the end of last year carried over into 2015, and their impact on the Canadian economy forced the unexpected. The Bank of Canada cut the bank rate, and also we've seen other central bankers using extraordinary measures, also known as quantitative easing, to help reduce volatility and keep confidence in their respective economies alive. Global economic results for the first quarter of 2015 have actually showed significant slowdowns, especially in the U.S., and at the beginning of this year, that was something that was not expected. What is expected is that in the second half of 2015, the U.S. economy will lead the global economic recovery, and that the U.S. Federal Reserve will start to normalize interest rates sometime in September. Well, the Bank of Canada has pinned the hopes of the Canadian economy on an improving U.S. economy in the second half. But today, Governor Paul has qualified this in a speech in Charlottetown, saying that the global economic cross-currents are becoming more difficult to navigate. To date, for the data for the second quarter of 2015 thus far have been unimpressive. I'll talk more on this a little further along in today's presentation. On the inflation front, today the UK announced that inflation had declined to a level below zero in April. This is happening for the first time since 1960. So it's coincident that the Central Bank of England last week lowered their future growth targets for the rest of this year and for on into 2016. Another of our themes has been bond market volatility, or how that is playing into financial markets. Remember that financial markets take their cue from the bond markets, so we watch them very closely. This morning, the European Central Bank stepped up and announced that they will speed up their quantitative easing program in May and June in a response to the recent volatility. I'll talk again about this a little bit further along in more detail. Sorry, in a little bit further along in the presentation. And finally, one of our other themes, equities and equity investors. Well, they remain confident, and despite what we would consider to be relatively high valuations, the S&P 500 has been hitting new records. So that is basically the key to our themes. But let's go into these in a little bit more detail. Let's actually look at what's going on in the bond market. As I said before, central bankers do not like volatility, mainly because it erodes confidence in markets. It spills into the economy and it adds uncertainty. Simply put, when consumers are uncertain, they don't spend. When businesses are uncertain, they do not invest. This hurts economic growth, and because bond markets have been volatile of late, especially in Europe, and I'll just pop up a quick chart here to show that volatility, and it's quite significant. It was too much for the European Central Bank, and therefore they announced this morning that they'd be increasing their bond buying program through May and June, as I said before. This is intended to calm bond markets by adding liquidity and providing a buyer for those that are sellers of bonds. And it helps to take out some of the downward pressure that the bond prices have been experiencing, at least for the moment. Bring a little bit of calm back into the markets. Well, with that added liquidity, investors are definitely moving out of bonds and they're looking at equities. They're feeling somewhat more confident about global equity markets. And this has translated into, once again, seeing S&P 500 making new highs, record highs at the beginning of this week or yesterday when Canadian markets were closed. So let's look at what is happening in the U.S. economy, because again, one of our themes was that the U.S. economy is expected to lead the global economy in the second half. Well, at the moment, what we're actually seeing is that the latest data are pointing to a decline in consumer confidence and consumer spending. If the consumer is not buying, that means that inventories are sitting on the shelves. And when inventories are sitting on the shelves, the next stage is that producers start to slow their production. On Friday, we saw the index of industrial production, but basically that showed us that as inventories rise, companies have to lower, as inventories rise, producers are producing less. But also, when inventories rise, companies have to lower prices to move the stuff off the shelves. When sales revenues are already lower than expected for this year, this actually could start to hurt earnings. So it's not really a good situation when you already have price to earnings ratios at relatively high levels. And here's a chart that I've been showing often as we look to see where relative values are. And as we've been saying, and another one of our themes, of course, has been that relatively speaking, equity prices are expensive. So those are some of the things that over the last week we've been adding into our current thought process. And I'm not sure if Paul wants to add anything here or not, but I'll just sort of see if he does.
Yeah, hey Scott, I think I made this comment last week, and we should have added a chart similar to the one that you have on the screen right now. But we should have, as opposed to looking at earnings per share or PE ratios, where we've seen enormous buybacks, specifically in very large cap U.S. companies, where the denominator, the share count, is dropping like crazy. One thing I was just looking at on my Bloomberg screen right now is kind of interesting, the S&P 500 companies. The cash flow, so if we look at macro fundamentals, the cash flow from operations on S&P 500 companies actually peaked in 2013 and declined in 2014 and is currently in decline even beneath that. And of course, similar to a previous chart you put up about consumer confidence being simply it's not a hard number, it's simply how people feel as opposed to retail sales, which is a hard number. Similar to that, what we see and we've constantly seen is analysts' expectations are still too lofty. So I think, I wonder if we can do a chart next week. I have to look at it, but cash flows are actually dropping. Companies are not producing as much cash flow as they did a year ago or 2 years ago. And that is not a great thing for the market.
And I can't disagree, and I think you're right. We should look a little further into that for next week, and I'm sure that will definitely bring some of our listeners back. So that's a great thing to stay tuned for next week, folks. Okay, so all of this economic stuff that we talk about every week is important and helps to allow us to look at our portfolio models and then narrow our focus in to say, okay, what is it that we think we need to be doing, if anything, in our models? So let's talk about what we are doing in our portfolio models, and let's start with fixed income, because as I mentioned earlier, with bond markets being volatile, we think that this is presenting some opportunities to us for buying. And one of the themes here is that, yes, using lower prices and higher yields, it makes sense to be adding to our portfolios. And here's a chart that we actually looked at last week, but we'll just bring it back into view. We've seen Canadian bond yields trading at the upper level of their recent trading ranges. So last week we added some Government of Canada bonds to our fixed income model to take advantage of these more attractive yields. And actually, Paul, you can correct me if I'm wrong, but I think we've actually seen them come down a little in yield since then and actually moved up in price.
Yeah, just marginally. They're still, right at the top of that sort of band, and we are watching them closely to see if they're going to break out to higher yields or whether they hold in that band area, the top of that band. So we're being pretty cautious in here, but we do need some government bonds to help mitigate some risk in the portfolio and reduce volatility. So we're waiting for a slightly better buy point.
So we're adding some, but we're keeping a bit of powder dry to see if we do get better yields and lower prices. Then again, we've got some opportunity, and we can take advantage of it. Okay, let's move on then to our global equity model, and obviously, as I've been saying, we've been cautious with new buying. But we have been rather active switching out of higher cost ETFs that I've had in my past models into some lower cost ETFs. And when I first moved over to High Rock, one of the things that I was really excited about was being able to have some time to get in and do some research on what the best strategic moves would be for some of the existing ETFs. Could we find alternative ETFs that gave us the same exposures, gave us the same diversification that we wanted, but allowed us to lower our costs? And that was a great opportunity, and we've been actually getting active switching out of higher cost ETFs into those lower cost ETFs. So that's what we're doing in the global equity model. And then again, I just want to point out why, and I'm not bringing this slide back anything for other than emphasis, but I do also want to stress, Paul, that we're not necessarily stock market bears, but we are just not comfortable putting new money to work when most of the broader indices are running at their highs. And I think that's something that we want our clients to understand, is that we do not just throw money in at any point. We do pick our spots, especially if it's new money that's coming in. We want to be careful that we're trying to find the best opportunity.
Yeah, I agree with that, Scott. And probably leads to the next slide, I think, if you wanted to talk about the Canadian growth equity.
Yeah.
I guess looking for value is probably a good way of putting it, whether it's the fixed income model, the growth equity model, or the global core equity model. We're always going to kind of look for value.
Well, I know that you've been busy looking for value in the Canadian equity growth model, and so I think maybe what I'll do is let you talk a little bit about that.
Okay. I will be somewhat brief, but I will go through and just as we segued into this slide, when Scott and I look at buying or selling anything, we look typically at three determinants to see what we're going to do, whether it's a stock, a bond, or a low-cost ETF around the globe. We look at three things. Number one are fundamentals, and again, whether that's macroeconomics, which we've gone through some of that with you today. They may be more micro level or bottom-up fundamental analysis on a single company's stock or bonds, or a government bond, etc. We look at fundamentals, and specifically in the Canadian growth equity, that means going through financial statements of that company. We do read some research in the street to see what equity analysts, who I feel mostly cater to retail investment advisors and their investment banking colleagues, but nonetheless it can affect the trade of stock. But we do our own research. We keep up-to-date Excel models on companies that we look at, and certainly companies that we invest in. So that's sort of bottom-up fundamental work. We also, number two, look at technicals. So we do look at charts to see, well, there's a chart coming up right now on Air Canada stock, which I'll talk about in 1 second. But we look at entry and exit points. That's what we use charts for. And quite frankly, Scott, I think you probably taught me how to look at charts. And the third thing we look at are flows. So we want to know what the street is doing. Institutional investors, large institutional investors, maybe large holders in a particular stock or a bond. Those all matter. Retail investors, what investment advisors are doing, and quite frankly, we want to be at least one step ahead of them. And if we can be a step ahead of other asset management firms, and we can be, I'm pretty sure we can be more than one step ahead of most retail investment advisors, then we're better situated to profit from our positions. So on the screen, Scott has Air Canada stock. We bought the stock last week after their first quarter of 2015 numbers. They released their numbers, and they were better than expected by all accounts. And the stock traded up that day. I can't remember exactly what day it was, but it traded up towards 1275, and to us that looked like a bit of a breakout on a couple different levels. And I was very surprised and pleased that the stock traded down to the low $12 range. And you can't really see it on the chart terribly, but it is after that little gap on far right side, first line, or maybe the fifth in from the right, that day, and it traded back down, and we were able to buy some at 12.17, and we bought our full position, which for most of our clients would be a 1% weight, and it's traded up today. It's traded up to around $12.90, which is about a 6% increase. And again, for our clients, that's net of all trade costs, et cetera, which Higher Rock absorbs. So just really quickly, in kind of a 30,000-foot view, but why did we do that? Well, we go to the fundamentals, the first thing that we look at, and Air Canada trades, and has for a long time, traded very cheaply to U.S. legacy carriers on a couple different valuation metrics that we track. And using those same metrics, we work out a valuation of this stock around $19.50, which is about a 60% increase from $12 where we bought it. So I think we're reasonably protected. And of course, the airline industry can be volatile for sure, but it's changing a lot. And a couple of the major things that have changed with Air Canada, the number one major thing that's changed is the large legacy pension deficit that they used to have. And 2 years ago, that was about $4 billion, and today it's positive $600 million. So that significantly increases Air Canada's cash flow. And again, we talked about the S&P 500 cash flow. Cash flow is ultimately one of the most important things when you look at a business. And then something else that's very important. Obviously, you've seen, probably all heard about oil dropping from whatever it was, $110 a barrel down to a low of 40, currently at 57. But that also has dropped jet fuel prices in the same sort of ratio. So Air Canada has very little hedging on their jet fuel, so they were able to benefit, like most of the other carriers around the globe, and certainly in North America. Now, some of that lower fuel cost of jet fuel was offset by a slightly weaker much weaker Canadian dollar, actually. But the ratio of fuel is much more important than the weakness of the Canadian dollar. So they are expanding capacity, adding new routes, and these are all on higher margin routes. Planes are getting much more efficient. So all the planes now that they're buying and leasing are way more fuel efficient, and as well as, quite frankly, we all know it, but they jam more seats. Technicals we looked at, again, I talked about that. I mean, we thought it had a minor break to the upside. You can see on that chart that I think $14 will be a little toppy, and I'm not 100% sure we're going to sell our stock at $14. We may trade out of half of it at 14 and look to rebuy back down. If we can get stock out at 14 and back down at 12.5 or 13, we might do that, but we do think ultimately it is worth 19.5. So we don't want to be too cute. Sell at the top end of that chart range as you see it at 14 and have it go to 16 and we own 0. So we want to be careful with our all of our fundamental technical and of course the flows. Right now the flows are quite important because I think there's a big shift going on where institutional investors are starting to warm up to airline stocks after decades of avoidance. So the other thing that is quite interesting that last week at Air Canada's first quarter conference call, which I was obviously on, they started talking about the potential, because this pension issue has gone away and they don't have to fund it with cash flow. They should have excess cash flow, and I'm not sure they will, but they talked about paying a small dividend. And 2 U.S. carriers, American and Delta, actually do pay a small dividend. This is kind of unheard of for a U.S. or any North American legacy airline. So I'm not sure Air Canada is going to do that. But for them to even mention it might be enough to drive in some retail or even yield type mandate, institutional mandates, and retail investors that are always looking for dividend yield. If they put a dividend on Air Canada, it would be very, very, very small. It's not even 1% on American and Delta. So anyway, that's a bit of an overview on how we look at things, fundamentals, technicals, and flow, and specific to Air Canada, why we made that purchase.
Well, thanks, Paul. I think that certainly helps people understand some of the things that we're thinking when we're making these decisions, and we don't make them lightly, obviously, and we look at a lot of detail to make sure that we're doing what we think is the best thing for not only our clients, but as everybody knows, all our clients know, we're investing alongside, or you're investing alongside of us. We're investing together. So these are, and that's pretty important. If I'm putting my money in to Air Canada stock, or you're putting your money into Air Canada stock, we want to make sure we're getting the right situations and getting the right prices. All right. Well, thanks for that. And I'd like to, I guess at this point, say that's all of we're going to talk about on our weekly call. But we would certainly, at this point, invite anybody who's joined us today to ask any questions that they might have. And that would be questions for any of us, even if it's a planning question. We're more than happy. All right. Well, it sounds like nobody's going to get up and be brave. So I will invite all of you who are listening or would be listening on the recorded version. Please feel comfortable to email us if you have any questions. We are more than happy to have you send them to us. We'll make sure we get the answer. And it's always a great opportunity to get those questions and use them for discussions for these weekly calls. So anyway, feel free to send us any questions that you may have. But that's it for another week. Thank you all for taking the time to tune in. Wishing you all a great week on behalf of myself, Paul, and Bianca. And for our U.S. listeners, I know we have a couple. Have a great Memorial Day weekend. And we'll be back next Tuesday with another webinar.